everyone. Thank you for joining our webinar today. My name is AJ Shaker, and I'm a director with Provident Healthcare Partners. I'll be moderating our webinar today, and our topic of conversation is an update on consolidation trends in the oral surgery specialty. It's an area that's been gaining some significant attention from PE sponsors, from strategic consolidators, investment banks, attorneys, oral surgeons as well, just in light of really the robust level of transaction activity we've been seeing in the sector. Just in light of that, we thought it would be a really opportune time to host a webinar, and we're very lucky to have some great panelists for our discussion here today. They all have some unique perspectives, which should hopefully make for a very informative dialogue for everybody that's listening. And so we appreciate everyone joining our webinar here today. And without further delay, I'll introduce everybody to our everyone on our panel to our audience and just ask them to provide a brief background on themselves and their firms. So let's start with Craig Woods and Dean Gould from Dykema. Craig and Dean, welcome. Thank you for joining us here today.
Yeah, thanks for having us. We really appreciate it. And thank you for the introduction. So my name is Craig Woods. I'm a partner here at Dykema Gossett, and I help lead our healthcare mergers and acquisitions and capital markets group. Dean, who's on the call with me today, Dean Gould, is my colleague and works in the group with me. We specialize in representing healthcare providers, private equity sponsors, and in a wide range of healthcare related transactions. We're really excited to be here today, have a lot of experience on the oral surgery side, and hopefully we'll have something to add to this illustrious panel.
Great, thanks, Craig. Next, we have Steele Windle from 5 Points Capital. Steele, thanks for joining us.
Thanks, AJ. Thanks, everybody. We're excited to be here. I'm Steele Windle. I'm a principal with 5 Points Capital and have been with the team here for 8 years. 5 Points Capital is a lower middle market private equity firm based in Winston-Salem, North Carolina. We're about an hour north of Charlotte. Our group was founded in 1997, so 25 years ago. We're currently investing out of our 4th equity fund. We're exclusively focused on the lower middle market, and healthcare services and products businesses represent just about half of our portfolio today. 5 Points Capital partnered with Carolina Center for Oral and Facial Surgery to form Flagship Specialty Partners in December of 2021 last year. The surgeons at CCOFS had built a very nice, highly respected practices with offices throughout the Carolinas. And it reached a point where they recognized that they wanted a partner to help manage some of the non-clinical elements of the business that they had built. And they wanted the support of a partner to help accelerate that growth and to support their vision going forward. So Flagship Specialty Partners was established to serve as the management support organization to provide those non-clinical support services and help carry on their vision in partnership with many other surgeons and practices that will also join the Flagship platform.
Great, thanks, Steele. And last but not least, we have my colleague Eric Major from Provident Healthcare Partners.
Yeah, thanks, AJ, and good to be back on one of these webinars. So Provident Healthcare Partners, just as a recap, we're an investment bank headquartered in Boston, represent healthcare services companies across the U.S. Through transactions, and specifically spending a lot of time within provider services with physician groups, dental groups, physical therapy groups. We've been very active in oral surgery and have closed now 2 larger transactions in the space and have another opportunity that we're working through right now. So hopefully we can share some insights on what we've seen within the industry over the last couple of years.
Terrific. Thanks, Eric. So just rewinding back a bit, we at Provident had actually done a webinar with the folks at Dykema in probably early 2020 on the oral surgery space. At that time, oral surgery was still pretty early in its transaction cycle. There's a few platforms within the space that were private equity backed, US OSM, OSP, Paradigm, but really since then, Several platforms have been established, including Flagship, which Steele is, representing here on our webinar. And just really a lot of transaction activity, both in terms of bolt-ons and those new platforms being formed, as well as some challenges and opportunities that came out of COVID as well at the same time. So that kind of feeds into the first topic of our webinar here today, which is really what's been the driver of investment and consolidation activity that's happened since 2020. Eric, maybe we can start with you for some of your perspectives.
Sure. Yeah, I think we've seen obviously increased activity in the sector. I think the oral surgery and kind of specialty focused model, I think, is really resonating with other oral surgeons across the country. Historically, their options were primarily to either sell to other associates or, sell to a DSO. And I think, that all that option can be attractive to some oral surgery groups. I think joining an organization that's focused exclusively on oral surgery, I think has been a really attractive option for these individuals. They can have representation on the board that's, a bunch of oral surgeons and share best practices with other oral surgeons across the country. So I think just that specialty focused model has really resonated, and we've seen obviously more and more private equity firms get into the sector. Certainly, there's a lot of fragmentation in the market, but if you look at an oral surgery group, particularly if they're doing a lot of implants, you can have 3 or 4 oral surgeons that are bringing in, north of 10 million of revenue. They can be very, productive oral surgeons. So while the market is very fragmented, I think there's, meaningful opportunity to grow EBITDA and scale, pretty quickly. And I think that, the consolidation is really early stage within the market. Obviously, US OSM was kind of first to move, but we've seen a lot of new investors get into the space like 5 Points, and I think there's a tremendous amount of opportunity to consolidate an extremely fragmented market. And obviously, there's a lot of tailwinds in the space. I think oral surgery fared pretty well during the pandemic, which I think reaffirmed investors' interest in the space, where most oral surgery groups that we work with had a small dip in their volume in the early stages of the pandemic, but were able to recover relatively quickly, given the medical necessity of the procedures that these oral surgeons are doing.
Yeah, that's great, Eric. I'm sure a lot of what you mentioned were, boxes that, Steele and his team at 5 Points were evaluating through their experience kind of creating the Flagship platform. Steele, if you wouldn't mind kind of speaking to some of your thesis in the space, I'm sure part of it resonates with what Eric just mentioned, and just broadly your experience creating that platform would be great.
Yeah, happy to. I mean, I agree with everything that Eric said. One of the reasons we were attracted to oral surgery to begin with is just that the specialty is in its very, very early innings of consolidation relative to the, for example, the general dentistry space, where consolidation's been happening for, several decades. I also agree with Eric. I think there's been a growing recognition among practitioners that partnering with private equity can be a very nice alternative to the traditional buyout path that many doctors have historically opted for. That is selling your practice to a rising physician as you near retirement. Not everyone will have that traditional option, and that traditional option doesn't always meet all of the objectives of what a surgeon may be looking for, some of whom may not be close to retirement, but still want the support and the economic benefits that come from, partnering with someone that can help build their platform and, take some of the risk off of their shoulders and some of the administrative burdens off of their shoulders as they continue to grow their practice. In terms of what we were looking for when we were forming Flagship, there's a lot of fundamental diligence items that, Eric touched on that were important to us. But I think as we were considering an investment in the space, and we'd been developing a thesis for some time, I think culture and a shared set of core values and ensuring that there was a shared vision with the practices with whom we would be partnering was very important to us, a very important element of our criteria as we were contemplating an investment in the space. We wanted to make sure that we were partnering with surgeons that were well respected, where the culture at the practice was very healthy, where there was a willingness to allow us to help invest in their business and to add to what had been built, when that all requires trust. And so there was some intangibles that were important to us as we were evaluating opportunities. And we also wanted to partner with a group where there was real enthusiasm for growth going forward. And I think there's plenty of surgeons that fit that criteria, but those were things that were really important to us as we went down the path.
That's great. That's really helpful context, I'm sure, for our listeners. Dykema team, I know we've talked a lot about some of the work that you've done, both on the buy and sell side of these transactions. How have you seen the options evolve for oral surgeons considering a deal since our last webinar back in 2020?
Yeah, back in 2020, I think the options were a lot more limited. I mean, groups like Flagship weren't really out there. There were just a couple of large players in the space. I think people were still trying to wrap their head around how to build a specialty platform. A lot of the momentum had been on the general dentistry side. And whenever you started talking about oral surgery or endo or other kind of, specialties, they were always just somewhat add-on segments to kind of a general dentistry platform. Kind of one-offs here and there. If there was a kind of a strategic need for something like that, where they thought they could, fit it into their platform and it would make sense. But I think a lot of it, what you're seeing now, is because of, those limited offerings have done so well in the last couple of years. I think that there's kind of a blueprint, if you will, that I think a lot of people have seen. They've seen that success, and they see that there are opportunities to grow because, like Steele and Eric said, we're just at the early stages of consolidation. So I think that those have been kind of, the things that we have seen change the most. I mean, obviously COVID happened, that was a big deal. And I think it's also been a driver here because a lot of people have looked for creative ways to diversify risk for them. A lot of times before it was more regional based, especially with COVID, there were certain parts of the country that just were a little more open maybe than others. And so it created, depending on where your platform was located, that was some way there to diversify your risk. But here, I think just having a specialty platform as well, depending on how you kind of fit that into your overall strategy, also has allowed some people to think creatively about how to diversify that risk. And then I think the other thing too, and the final thing, is just some of the, just real world market drivers here. I mean, we have an aging population. There are more oral surgery needs for people. Implants and other procedures have become more common. And so I think that you're seeing people start to realize that there's a lot of growth opportunities in the space as the population continues to age.
Yeah, and to add to that, obviously in 2020, there were only a few consolidators of oral surgery specific. And since then, there's been, we're up to 7 or 8 or 9 now. But within that, there are larger DSOs and even middle market DSOs who are making an effort to grow their oral surgery side. So you're looking at a marketplace that's not just driven by oral surgery specific consolidators, but general dentistry DSOs, as well as multi-specialty platforms who have an endo arm, an oral surgery arm, or perio arm, and use that to grow their platform rather than just focusing only on oral surgery. So I think that the number of opportunities out there for oral surgeons is just grown, not just within oral surgery specific consolidators.
That's great. And Dean, I think your comments segue into probably one of the most common questions we get from groups we interact with in the OMS space that are considering doing something, which is, what types of transaction options exist out there? What could be right for my group and my shareholder situation? What are some of the pros and cons of each? Maybe we can start with Eric and kind of go through with Steele, Craig, and Dean about the types of transaction options you're seeing in the market and how you might frame the availability of those to the surgeons that you're speaking with.
Yeah, so I think the first option for groups is they could be their own platform, and starting to build the MSO, one-on-one with a private equity firm. And I'd say this is typically going to be reserved for the largest groups in the industry. I think the challenge with oral surgery is I think a lot of the practices out there may not be at the level of scale to be considered a starting platform. But we have seen investors, that are working on deals in the space or recently closed deals in the space are kind of starting with, maybe one or two smaller groups and bringing them together in order to, build a platform, at least the framework of a platform. But in a platform transaction, obviously the benefit in that case is typically you get, board representation on the top board of the organization, alongside the private equity firm. You have the ability to sort of, develop and negotiate the operating agreement for the company and a lot of the, foundational documents that typically, only groups that join a platform very early on have influence over those types of documents. So there's some, benefits to doing that. I think obviously the cons to that is, building a platform isn't easy, especially when you're competing with other platforms in the sector that might be, more advanced and more developed than you are, because those types of groups are already out there talking with other oral surgeon, practices, and they can sort of illustrate the infrastructure that they've built, and it can be difficult to kind of compete from a growth perspective with well-established groups. But there definitely are some practices nationally and some pockets within the US that haven't seen much consolidation activity, where there could be opportunities for groups to be their own platform and align with an investor that has a thesis within oral surgery and also, has experience working with provider groups, whether it's physician groups or dental groups.
Great. Steele, how about from your perspective?
Yeah, I would echo everything that Eric just mentioned. I think, not every practice can be a platform, and not every practice should want to be a platform. I think most practices with fewer than, 15 or 20 surgeons and fewer than 100 or 150 total employees would have real difficulty becoming a platform. That not even just in oral surgery, but most companies will reach an inflection point where continued growth requires a whole new level of managerial support, whether that be IT support, accounting support, HR support, operational support. And if you don't have that in place, it's really difficult and expensive to try and grow at any accelerated pace, whether you're trying to open new offices, hire new surgeons, look for acquisitions. It's just hard to do it without that infrastructure in place. And so for that reason, a lot of practices, probably the vast majority of practices that are looking for some type of transaction event, will make for great candidates to join an existing platform where all of that infrastructure is in place. You can still maintain your clinical autonomy. There's a lot of objectives that will still be met the same way as it would if you were a platform, but you still get all the transactional benefits that come with partnering with an existing platform. You become a part of a network of like-minded surgeons. There's an ability to share best practices. Obviously, there are economic freedoms that come with transacting with an existing platform, and you can continue to make a great living on an ongoing basis, and you can remove a lot of the administrative burdens that might wear you down if you're trying to go down the path on your own.
Great. And Craig and Dean, from your perspective, you've seen even transactions outside the typical kind of majority recapitalization. How have those kind of played out, and what's kind of your perspective on having advised on some of those types of deals as well?
Sure. I appreciate that question. I mean, I think it kind of falls into a few different camps here, right? Like, first of all, I think the first question we always get from people is, do I have to affiliate with a larger platform, or do I have to look for a PE deal, or can I remain independent? There's other people that decide that if they kind of want to remain independent, if you will, do they look to kind of merge with another, equal sized group out there, or loosely affiliate with that group in order to position themselves for a favorable transaction in the market? So these are questions we kind of get that are somewhat, I would say they're a little atypical, in this current market, because there is no doubt that there's an incredible momentum, in the in the healthcare space, including in the oral surgery space. And so, that first question of, do I have to remain, do I have to join with someone, or should I go it alone? Steele kind of touched on these things a little bit. I do think there's an inflection point for everyone where they have to determine, if they want to do everything themselves, or do they want to grow through joining with a larger group that already has an infrastructure in place. We're very familiar with Steele and And with Flagship, we work closely with them, and the things that they have built out in their organization are things that I don't think are commonly available to a lot of, one-offs out there, and that really do need the help in order to continue to grow. There are other people out there that may not be ready to really join someone because on the legal side, there might be things that they haven't thought about internally that really need to be worked through, things like their benefit packages, their payer mix and reimbursement rates. What are those going to look like going forward? I think those are things that have to be looked at as well. There's also too, like we use the word independence a bit, I don't view this as really a question about independence versus, I guess, control, by an outside group, because no matter what happens in an affiliation, doctors still have to retain their clinical autonomy, no matter who you partner with. A platform, a non-clinical entity can't tell you how to necessarily do your job or, how to do implants or oral surgery treatments for people. So you still have that autonomy. I think what you're really, having to think about is, do you want the flexibility to go in tomorrow and take a distribution out of a company that you own and you make all the financial decisions for? Or do you want to reinvest in a larger group and kind of row in the same direction in order to grow collectively? And so those are kind of the things that you kind of have to work through. I think the answer is different for everybody. The other part about, where we talked, before this webinar about, mergers, if you will, kind of in advance of a larger deal. Does it ever make sense for two groups to kind of loosely affiliate together in hopes of going to market, for a bigger multiple? We get that question a lot. I always tell clients it's different for everyone. I think the most important thing is you've got to have a sophisticated team of advisors who can assess your synergies and determine if these two groups make sense to join. Because just throwing 2 or 3 groups together and saying, let's have a large EBITDA and throw it out there in the market and get paid more money is not always the correct decision and doesn't always work out that way. So I think that it's different for everyone, and you have to have the right people looking at that to determine if you have those synergies to where kind of a pre-market merger makes any sense.
Yeah, that's great insight. And I think that the common thing we often run into and get questions on is which one's right for me. And we think it's important for the shareholder groups to kind of do their diligence on each option, leveraging, insights from colleagues who have gone through similar transactions, obviously, legal advisors, accounting advisors, banking advisors. Shameless plug for most of us on the webinar here today. But, it's important to kind of think through all of the options that exist to ultimately figure out what's best for the group. But maybe just kind of to double click on the specialty OMS consolidation piece. I think we've really seen that ramp up over the last few years in particular, and I think it's a key topic of conversation that comes up a lot. Would be curious from kind of the panelist perspective, and especially starting with Steel, what factors have really driven the success of these specialty-focused consolidators in terms of transaction activity we're seeing in the market? And maybe from the position of Flagship, how do you kind of position yourself to the oral surgeons that might be considering those multiple options that we just talked about? And would love to kind of go through the rest of the group from there.
Sure. Yeah, happy to touch on that. I think that OMS consolidation has been of interest because investors have realized that these are businesses that have very nice cash flow characteristics if managed well and can be very resilient through economic downturns. There's attractive payor cash pay dynamics in the space. There's been stability from a reimbursement perspective within the space. And as I mentioned earlier, I think the OMS space is very early in its innings of consolidation. Investors like to see fragmented markets where synergies can be realized, economies of scale can be built, and all of those attributes are present here within this space. AJ, you asked about things that maybe specialists should be cognizant of, or ways that we at Flagship try to just have conversations with surgeon owners that are contemplating selling their practice. I think that folks should just consider, who it is that they want to partner with, because it really does become a marriage in many ways. I mean, you need to be thoughtful about what you're looking for in a partner. money and sale proceeds are certainly important, but there are other criteria going forward that you should be considering. I think folks probably don't oftentimes take the time to really think about, what are your objectives today? And also, what are those objectives 3, 5, 7 years from now? What are your pain points today? What will a transaction help alleviate in terms of those pain points going forward? Do you really know the surgeons that you'll be alongside? Do you know their culture? Do you enjoy them? Do you have common objectives with them? Do you know your private equity partner and their approach to transactions and their core values? I think all these things are important. Have you talked with their references and what other folks have said about them and what the surgeons that are in the platform today say about them? I think those are all things that are really important to consider, in addition to just the economic specifics of a transaction that probably oftentimes might not get as much thought as is merited.
Absolutely. And Eric, from your perspective, what have been important to your clients that are considering, especially from a strategic angle, considering alignment with, let's say, a DSO versus a specialty consolidator?
Yeah, I mean, I think the biggest thing is just obviously maintaining referrals is important. The opportunity and challenge with joining a DSO is a lot of these oral surgery practices were built, referral base, dedicated referral base over a period of, could be decades. They're very sensitive to that. Their referrals are their business, right? So joining a DSO, the challenge you have there is you'd have to really understand, how much of their referral base is coming from that DSO, because ultimately, if you do join that organization, it's likely you'll have some attrition on some of your independent dental referrals, and you have to make up for that attrition through increased referrals from the DSO that you join. So it could be, a net positive, but it also could present a net negative risk to these practices, especially for oral surgeons that, feel really passionate about the referral base that they've developed. So, this alternative of joining an oral surgery focused group provides the option to, join the organization without necessarily disrupting those referrals, because ultimately those dentists are going to continue to see those patients, after they go to the oral surgery group for their procedures. So that, I think, really changed the game, from an oral surgeon perspective, where I think a lot of groups that we talk with feel much more comfortable with the ability to kind of, keep the status quo as it relates to their referral patterns, leverage the infrastructure of the MSO focus on oral surgery, and also, find some cost savings, obviously, in other ways to kind of streamline costs, like, dental implants, for example, being able to share in the economies of scale of their larger organization. That type of model, I think, has resonated really well, given it preserves those referral relationships.
And Craig and Dean, from your perspective, you've been through a lot of these, transactions from both a business and legal standpoint. What structuring nuances are there for oral surgery transactions that our listeners should be aware of and familiar with?
Yeah, certainly. One of the unique things about oral surgery is that it's sort of this hybrid and crossover between medical and dental. A lot of your oral surgeons are both dentists and medical doctors as well. And so in any type of review, it requires, legal to take a look at both medical and dental perspectives. And so that is certainly unique to oral surgery. But as it comes to just structuring the practice, the management structure, it's substantially similar to any type of other specialty within dental and otherwise, right? Cardiology, urology, dermatology, they're all structured similarly, where at a high level, the buyer, like Flagship, for example, is going to come in and purchase substantially all the non-clinical functions of the practice in exchange for cash and equity, and working for the upside within the platform. And then the practice remains, and there's the separation between the buyer and the practice, just because we have corporate practice of medicine, the doctrine that doesn't allow for the private equity company to come in and buy directly. I think that our involvement would be much more limited, and Steele might have a few less headaches if he could just go in and buy the practice directly, but that just can't happen. And so we have to have that continued bifurcation between practice and buyer. I think one of the nuances that we're starting to see just generally in the space is this emergence of joint venture opportunities for sellers. So in a traditional private equity structure, there's going to be a roll up into one singular holding company that everyone's going to share in the upside of. I think in the marketplace, there's a lot of discussion about how to handle ongoing distributions. You're dealing with a selling doctor who's owned their own business for decades and is used to, taking out the profitability on an ongoing basis. And so to factor that in, there's a number of groups, less on the oral surgery specific, but more within the general DSO, that are allowing for the doctor to set up a sort of a joint venture that allows for them to have some sort of profit sharing. And we hear a lot of talk about that when we hear from our clients is, what can I do for profit sharing? Buyers come to us saying, we're hearing that our competitors are doing this profit sharing arrangement. How can we restructure ours in order to ensure that we can compete with those buyers who are offering that to sellers? And so we're going to see some more movement on that. I think it's becoming a growing factor because some of the bigger and some of the players that have been around for longer are starting to use that as their selling point. And so it'll be interesting to see how that grows over time.
Great. And, we've seen the level of deal activity really pick up in the OMS market over the last few years, which has really made clear some repeat qualitative themes in terms of what are, the qualitative drivers of value in these transactions. Would love to hear everyone's perspectives on, really what, acquirers, whether they be sponsors, OMS specific or specialty consolidators, DSO consolidators are looking for and the valuable acquisition opportunities out there. Craig and Dean, from your perspective and on the deals that you've worked on, what's been, some of those main qualitative drivers that have led to good outcomes for your clients on the sell side?
Yeah, on the sell side, and Steele touched on this, and this is where his group has got a great starting point, is I think culture, core values, and shared vision, and a collaboration between doctor and management is critical. All of the great things that a private equity consolidator can provide only go as far as the doctors produce. Revenue is driven by the doctors. And so happy doctors, create for a very, very successful business. And in order to keep doctors happy, we obviously have the financial incentives by having them roll into the organization. And we can structure any sort of way to keep them financially motivated. But beyond that, I think keeping them motivated professionally and making sure that their voice is heard in this collaboration, and that there's just a unified vision between management and provider. And that goes for consolidators that have grown to 300 practices to ones that have just gotten started. I think that those that we hear back from, the sellers that we hear back from a year later, and we ask them, how are things going? They say, my voice is heard. I'm involved in decision making, and that's just not on the clinical side; that's on the business side as well. So I think that the successful consolidators understand that the doctors were good business folks themselves. They built a business they wanted to buy, and let them continue to do that, and don't really interfere with some of the things that were successful for that seller getting to the point to be purchased. So yeah, I would say that certainly alignment between doctor and management is the critical factor.
Terrific. And Eric, from your perspective, what are some of the kind of key positioning themes that you've seen in successful sell-side outcomes?
Yeah, so I think there's a few things that come to mind. We touched a little bit on incentives and alignment with providers. One of the key things that you really have to work through in these deals is, associate surgeons, and making sure that there's a path to equity for them and that they're being treated fairly out of a transaction. A lot of these associates can be high producers and can be meaningful pieces of the business, and it's obviously not easy to recruit in oral surgery. So making sure that there's a alignment with the key providers in the group and non-owners in addition to the owners, I think is a critical piece of kind of positioning the deal. Other things would obviously be the level of infrastructure of the group. We've seen some oral surgery groups have actually created their own kind of mini MSOs and, professionalized the group and kind of taking it from a practice to a true business. And I think those are the types of groups that we're seeing, might be a little bit lower margin, but, are seeing, platform type multiples in the market. Also showing an ability to recruit, and it kind of goes hand in hand with making sure your existing associates that are employed have a path to equity and are treated fairly in the transaction. You also want an organization that has a track record of recruiting, and that might, come down to geography as well. Obviously, some markets are more difficult to recruit to than others, and that can certainly weigh into the positioning and the value that a buyer is willing to pay. If it's a group that has a really successful track record of recruiting and maybe has some unique relationships with with programs across the country where they're able to get early access to new recruits that are looking for full-time roles. And then, going with that infrastructure, it's also, is there management in the business? Groups that have invested into, a controller or a CFO and, a non-surgeon who's sort of running the day-to-day. I think those types of groups will be kind of considered more as a platform and will likely see, more widespread interest, because ultimately those groups could be a regional platform in a new geography for an existing MSO that maybe doesn't have operations nearby, or a starting platform for a new PE firm. So those are the types of aspects more on the qualitative side that we think will drive valuation for certain OMS groups.
Hey, AJ, real quick on that question, and I'm sorry just to jump in really quick, but just one point to add to what Eric said is that, Eric mentioned that, you're seeing companies or you're seeing organizations kind of form their own MSOs. And I would just add to that, because there are a lot out there that have done that. But I do think it's really important for those groups to really on the front end take a look at what they have formed and just making sure that it's properly set up, because a lot of groups think because I've got a separate company and a bunch of documents that say I'm a management company, they go to transact and they realize that the infrastructure that they should have in place to really drive value isn't there. And so, every company's different. I think the level of, sophistication with their setup is different for everyone. And so I do think it's important for people to understand that if they are thinking about transacting anytime in the future, they should look at that, because just having a management company necessarily on paper doesn't always drive value.
Yeah, that's a great point, Craig. And I guess, Steele, from your perspective, what gets you excited about, a potential bolt-on opportunity to Flagship? And similarly, what components of value are you trying to build within the platform for, a successful future outcome?
Yeah, just in terms of things that are important to build value, I think as others have mentioned, I think at the outset, alignment of interest is really important, just in terms of, the shared vision for growth going forward, and also from a transactional structuring perspective, ensuring that there's true alignment of interest around the table. I think that's very important to us at 5 Points. I think as you look at add-on acquisition opportunities, I think, again, having a shared vision for what they want to accomplish going forward is very important. And we really do consider that, and making sure that there's a good fit with that practice. I think what their objectives might be as they look forward 3, 5, 7 years is important. And I think you also need to just be able to demonstrate that you've been able to grow in a number of different ways historically. From a broader platform perspective, as we grow Flagship over time, it's going to be important for us to ensure and demonstrate as time goes on that we can successfully grow in a number of different ways. We want to make sure that we can, hire and retain new physicians. We need to be able to demonstrate that we can open brand new locations and make them profitable in quick fashion. Source and close acquisitions, and ensure that at the end of the day, there's a pathway for someone else to keep doing those same things after you. And I think those same things hold true on a much smaller scale as you think about, whether or not an add-on acquisition of a potentially selling physician is, whether those attributes are there or not as well. Those are certainly important criteria to us. I would just add too, there's been a couple comments just around, the attractiveness of joint ventures that might be formed in affiliations or profit sharing arrangements across practices, and whether or not, those, the attractiveness of that type of an arrangement. And one thing that's important to us as we think about, building a platform that's best suited to be a real functioning business is just the level of integration that really exists in your platform going forward. If you partner with, a consortium of practices and you're sort of a loose arrangement of practices, but there's no real operational, synergies between your practice or no shared oversight in any operational way, there's a little bit of a question on our minds around just, what exactly are you as a group? What are you a true business, or are you just all loose affiliates of, some broader organization that, you're all just members of the same club, but you're not really a business? Those are the types of things that would go through buyers' minds as they evaluate the attractiveness of purchasing a group of practices that are a part of an organization such as that.
All really great points. And I think it dovetails into probably the most asked question and kind of hottest topic that we run into, which is, what trends are we seeing in valuation? Obviously, there's a big variance in terms of the multiples that have, been out there in the market for comparable and precedent transactions, some of which is kind of predicated on checking those boxes from a qualitative standpoint that we just talked about. But Eric, what's your perspective on the valuation environment today, and what factors are feeding into that?
Yeah, sure. I mean, I think as the oral surgery market has garnered more attention from investors, I think we've seen, on recent transactions, more and more interest, partially just, supply and demand dynamics with more groups closing deals in the space. But I think some of the factors that are going to really determine the value of an oral surgery practice, I mean, number one, obviously diversity of the collections across the provider base, I think, is critically important. A group that has more providers and more diversity in those collections is going to see generally a higher valuation because there's less risk in the investor's eyes. Also understanding, the time, the career horizons for those physicians and the surgeons, and ultimately when they're looking to retire. Groups that have some high producing surgeons that might be within a few years of retirement generally going to have less interest and less lower valuations than groups that have younger surgeons. And a lot of times you see a mix of some surgeons that are older, some that are younger, but as long as you have sort of a base of younger physicians that will continue to grow with the practice in the future, I think you can tell a story to an investor that ultimately the business is and the growth of the business is sustainable in the long term. We talked about recruitment. I think that's critically important. Groups that have shown the ability to recruit high quality oral surgeons, I think that's a pretty unique proposition that investors will value in a process. Certainly growth potential. Groups that have really thought about growth critically. Are there underserved markets where you've identified that you could potentially open a location? Because ultimately, at the end of the day, these investors want to drive growth and support that growth. So a business that has ideas around where to grow next and how to accomplish that. Obviously, if you have relationships in the community that could be good acquisition targets, those are the types of things that will help to drive, valuations. But I think generally seeing valuations could be, from the mid to high single digits for, smaller oral surgery groups to potentially, stretching into the double digits for some of the really uniquely positioned, sizable platform caliber groups in the market.
And Craig and Dean, how have you seen that competitive element in the oral surgery space play out on some of the transactions that you've worked on?
Yeah, sure. Obviously there's been more competition. So, at times valuations have been higher. We're just the lawyers. You don't want us telling you all about valuation and metrics and whatnot. If you're asking us, then, you're already going down the wrong path. But at the end of the day, we do see a lot of deals. And yes, generally speaking, valuations have been higher. There may be some people out there willing to take more of a risk with regards to certain investment opportunities because, they want to get into the space. But I would say the flip side, is also true, which is that, with the increased valuations, I would tell sellers that diligence has become, I think, more robust in transactions because when buyers are spending more money, they want to be very certain about what they're getting. So I think that that also has kind of, played out. The transaction process has probably become even more involved than what it might have been before. I also think because deal size has gotten bigger in some, instances, you started to see the presence of rep and warranty insurance on more transactions, which, is sometimes factors into how you value a deal, whether it's the right size for insurance. And so I think things like that have also changed a bit, over the last, few years because of this. But at the end of the day, the same thing still holds true. Everything that Eric said is still correct. There may be increased competition, but factors like regionality, payer mix, synergies, growth opportunities are still all present. And those are all still part of how groups like 5 Points looks at, transactions, I'm sure. So while there may be more competition, if those other factors aren't necessarily in your favor, you may not get the valuation that you think you deserve.
Great points, Craig. And maybe Steele, from your perspective, having probably thought through general DSO investments versus flagship, which is obviously a specialty platform. Where do you see kind of valuation compare between a specialty oriented approach versus a general or multi-specialty DSO approach? How have you seen that play out in some of the transactions that you've looked at as well?
Yeah, I would generally comment that valuations for privately held companies are competitive across most all industries right now, really not just the OMS space. There's no shortage of capital right now in the private markets. And even as we approach some potentially, some economic headwinds coming up, I think valuations will remain a little bit elevated relative to historical levels, especially for well-managed businesses that can perform well through a recessionary environment. I do generally tend to think that valuations for specialty, practices that operate within specialty niches do command a little bit of a higher valuation relative to general dentistry, for example. I think there are just attributes of those types of practices from a profitability potential standpoint, from a reimbursement perspective, a stability perspective, as you think about just the channel in general. I think that there are attributes that make those practices a little bit more attractive relative to general dentistry. But again, I think valuations have proven to be elevated relative to history, not only across the OMS space, but the economy as a whole, really.
And I think it's important as people consider, attacking some of the valuations that are available, especially from the sell side, timing the market to maximize their outcome for their organization as well, but also to prepare in such a way that you can avoid common pitfalls that others have experienced going through a process. Maybe Dean and Craig, would love to hear your perspective, working the legal side of these transactions. What common pitfalls you tend to see with your clients, and how you advise groups to really prepare for that on the front end?
Yeah, absolutely. So I think a lot of sellers have been running in oral surgery practice, have just been running their business day to day without really considering a deal. And when it comes up and when they start hearing about it, and maybe even start receiving calls and term sheets that they're not expecting, they're not really ready to go to market from the legal perspective. And I think it's a little daunting for them once they get to the legal process, how much they actually have to provide, so that folks like Steele and his team can review and assess the risk. And so the diligence process, when they're not prepared for it, is very daunting. And so what we advise and what we think is important is for anybody who's in the OMS space to start collecting their documents, start having a little bit of organization, involving an office manager. They're somewhere, right? They just need to get organized and get into some sort of file. If they're paper files, start getting them copied and start getting your house in order. Because if you don't actually go to market, at least you've prepared and you have things ready to go. And then I think from a structuring standpoint, to involve advisors early. Most doctors are going to have a CPA or accounting firm that they work with, And to understand your tax structure from the front end can really be helpful. We work with a number of groups that didn't really think about them being a C Corp and potential tax consequences, got to market, got to an LOI, we negotiated it, and then they realized, oh my gosh, I'm going to be so taxed that this deal's not, worth it. And if they had known that on the front end, perhaps they wouldn't have explored it and would have started to restructure their organization in a way to prepare them for market. So I think involving advisors early and just getting your house in order can really start to prevent some of the headaches once you actually make the decision to go to market.
Yeah, and I would just add to that, just really briefly, one of the things that I always, that's incredibly important that sometimes folks don't think about is just making sure that your key providers and key employees are happy. I mean, it sounds simple, but when you're leading up to, a transaction, those folks have incredible leverage in your deal, even if they don't know it. I mean, these organizations, depend, on the human capital element for their company. And so if you have folks who are primary drivers of revenue for your company who are not terribly involved with the day-to-day management of the company, but are key drivers of revenue, it's, I think, incredibly important to make sure that they're happy, that they're locked in, whether that's through ownership, whether that's through incentives or, bonus arrangements that you have with them. I think you have to start thinking about that because just anecdotally, I mean, we've had deals where we've gotten close to a closing and a very key provider says, I'm taking a job elsewhere, or I'm moving, or I'm frustrated with something, and they leave. And, a lot of times your client doesn't understand that when a significant chunk of revenue was planning on walking out the door, that has a direct effect on your valuation and what your closing proceeds might look like. And so I think it's incredibly important for people to be thinking about that on the front end, if that means involving them in some way in the discussions in a way that doesn't interrupt your process, then do that. If there's bonus arrangements you can consider, think about that. I think those are all things that are incredibly helpful to make sure that you have a very smooth legal process if you're thinking about doing a transaction down the road.
Really interesting points. I think, for us at Provident, we often say, a lot of this job isn't necessarily kind of finance and accounting and strategy. It's a lot more psychology and, making sure that there's alignment. So I think your comments definitely echo that. Steele, from your perspective, what kind of pitfalls have you seen in the transactions that you've worked on, and what advice would you give groups that are looking to go through this process?
Yeah, I would echo everything that the Dykema team just said. Those are all very valid points. And I think just the upfront preparedness and having really given things some thought before you take the plunge into really considering a transaction is just very important. Just giving some thought around what you're really looking for in a partner and in a transaction and your personal objectives, not just today as part of, a liquidity event and cash and proceeds that you may receive as part of a transaction, but what do you want to have occur in the next 3, 5, 7 years? Again, do you know the team that you're going to be affiliating with, the surgeons that you'll be, alongside, the private equity sponsor that's going to be a part of your, a part of the partnership with you? Have you, looked into references and how they operate in certain environments and what their core values are and how they behave in certain scenarios? Those are all things that I think are people probably just don't oftentimes give a lot of thought to. They hear the chatter in the market around, the activity in the space and valuations that are getting thrown around and what their options are and all the interest in the oral surgery space. But, some of the longer term objectives as part of your quote unquote marriage that you might be stepping into are very, very important as you look down the road, and sometimes those aren't given the sufficient level of thought beforehand as people consider, just the economics of what the transaction might look like.
Definitely. I think, recurring themes of preparedness and, foresight into why exactly you want to go through this are definitely important. And maybe lastly, Eric, from your perspective, where have you seen things go awry, and how would you kind of counsel groups to prepare for those outcomes in the beginning?
Yeah, I would say without being too repetitive, I think the one theme we maybe haven't hit on is just making sure, from a financial perspective, you kind of know, what is the buyer paying paying a multiple off of as it relates to the earnings that you're monetizing the deal, and kind of having the financials in order before you go to market. So obviously, investment banking advisor can help with that. Sometimes we'll leverage a quality of earnings firm to do that as well with our support. But typically these deals are structured in a way where the partners will be paid on some percentage of collections going forward. We've seen different MSOs use slightly different percentage of collections, but generally in the probably 32 to 35% of collection range. So as an owner kind of going through these processes, you sort of need to understand, if you're getting a purchase price and an offer on your business, well, what is that based off of? What am I getting in terms of compensation? What am I giving up in terms of compensation by creating the earnings that an investor is going to pay a multiple on? And really understanding those parts of the deal and kind of going into it eyes wide open, I think is critically important, because ultimately, one of the main reasons why a deal doesn't get to the finish line is the earnings that an investor, is valuing the business off of don't hold true once you get through the buyer's due diligence. So kind of preparing for that up front and making sure that you're prepared to go through a buy side quality of earnings is something that we can help groups with on our side.
Yeah, I think that's a key point, Eric, that you just mentioned. A lot of groups don't necessarily prepare their financials in a way that is conducive to going through a private equity transaction. So it can be, a bit of a shift in terms of methodology, mindset, and just overall change for what a lot of business owners in particular are used to when looking at their P&L on a month-by-month or year-by-year basis. So with that, it looks like we're coming up to the top of the hour. We really appreciate all of the attendees listening into our webinar here today, and a big thank you to all of our panelists as well, who have shared what I think are some very valuable perspectives. I know there was a couple questions that trickled in, but I apologize for not being able to get to those. We'll certainly have the contact information for our panelists for you to reach out to directly, and can certainly answer follow-on questions from there. In addition, we'll plan to post the full recording of our webinar on YouTube and the Provident website. So feel free to give that a listen, share with your friends, colleagues who might find this to be a valuable resource. So thanks again to everybody who participated, and look forward to doing another webinar here in the short term. Thanks, everyone.
Thanks, everyone. Thanks, AJ.
Thank you all. Appreciate it.